Okay, good morning, ladies and gentlemen. Today is January 8th, 2021, and I'm Bill, and we're doing our first Power E-mini training of the new year. So, hope everybody had good holiday season, and we got a really good training discussion coming up here with Jeffrey. So, want to welcome Jeffrey. How you doing this morning?
Great, Bill.
All right, sound looks pretty good. Everything's all set up, so you want to go ahead and take it away?
Sure. I thought what we would do today, actually, what we're going to be doing this year is we're going to be doing ongoing training on the two algos that run through our alert software so that we can talk about like enhanced trading methodologies using the algos and just make sure everybody's on the right track as far as following the systems correctly. And so today, what we want to do, we're going to start off this week with the momentum system and uh, do a good review of that and talk about a couple key points that you need to be aware of when you follow the system. And I'll mention a couple enhancements that we've done and some extra tactics. So, taking a look at the software here, just to get started off, the desktop alert software, for those of you who may be new, we'll pick it up from the very beginning and just kind of get a review and talk a little bit about how it's meant to work and how we came up with it, and we'll go from there. Now, the desktop alert software is designed to be platform independent so that you can trade in any platform and just run this on your Windows machine. If you have a Mac computer, Apple computer, then you can use a Windows emulator and still run this software. So don't let that hinder you from uh, using this Windows software. Now, the E-mini alert software, the desktop alert software, I'll just give you a brief uh, history of its origins and how we came up with the idea. Basically, years and years ago, and it's probably 10 years ago or longer, we had a trading room like a lot of the other trading gurus out there. And, charts up, did trainings on like setups, was in the live room, chat with everybody, and, calling trades out, that type of thing. Uh, and there's lots of trading rooms like that. And as time went on, I realized that the trading room it was difficult for me to actually trade my own accounts while I was trying to also run a trading room. So I ended up having issues with being able to um, respond to people, call the trade alerts out, that type of thing, and yet be able to focus on the way I wanted to trade and the sizes I wanted to trade in my own account. So I realized there had to be a better way. Plus, a trading room, chat room, there's a lot of confusion. People are talking back and forth, maybe not paying attention. And also, a lot of the trading rooms out there, they suffer from uh, one thing. There's a human trade caller behind the scenes. And I've heard, uh, I've been in trade rooms where you can hear the kids clanging on pots and pans in the background, so the guy's out obviously running it off his kitchen table on a laptop or something. And I've also been in trading rooms where the trade caller kind of just disappears, and but there's all kinds of action going on. And I even found it uh, difficult sometimes to have the kind of energy to run the room and focus on that when you know that particular day I just might not be feeling real aggressive, but the markets might have been hot. And so you run into those kinds of issues. And so I thought there must be a better way to do this. And because I've been a software engineer my entire adult career, developing for the most part, big accounting systems for the corporate 500 type companies, uh, I switched over and started focusing on programming systems for the market. for trading. And so the epiphany came to me that I should encapsulate my trading methodologies in trading algos, automated signaling algos, and then build some kind of apparatus, some kind of receiver so that people could get those. And then I wouldn't have to, manually call the trades out, as well as, I would be able to use the system myself, right? They're my setups, they're the way I trade. So I would automate those signals and be able to follow it. So I kill two birds with one stone, basically. And so that's the birth of the concept of the desktop alert software. And I think we're pretty unique. There's a lot of installable indicators and oscillators and things you can get for your different charting platforms. But as far as a standalone signaling system like this is a very unique type of thing. And we've been around now with this software for, I'm going to say, at least 10 years, right, Bill? Something like that. This is our actual third rendition of the software as well. In other words, not just updates. We're talking like total redevelops. And so this is the best one so far. And we have two algos that will cover, the two big bases. One is a scalping algo, and another is what we call the momentum breakout system, momentum target system. They each play the market kind of a different way, and you can mix and match and play one or the other, or you can actually trade them both. And we have them running for the main E-mini symbols, the ES, the NQ, YM. There's oil in there, and then there is the 6E. So that being said, let's go ahead and we'll move on to the next slide there, Bill. So let's go ahead and review the two algos that are running through the desktop alert software. We have the power scalper and we have the momentum breakout. And so let's just cover the differences between the two. And like I said, this week, we're going to do a good review of the momentum breakout system. And then next week, we'll dive in and we'll review the power scalper. They're each very unique trading algorithms. If you scour around with all the hundreds of trading systems that are out there and have been invented, these are two very unique systems that I've developed over the years. I'd say over the last 15 years, and they are the two best that I've been able to come up with of all the different systems. So that's why I went ahead and created algos then that can send out the signals to the alert software. The algos, the system, run on a server and then send out the signals to your desktop through the alert software. Everybody's got their own channel and receives the signals. So the power scalper, let's just cover that real quick. That is going to be for the discretionary trader that needs to build a little bit of technical skill, looking at the charts and looking for the setups and whatnot, entries, and that's this type of trading is a little bit more aggressive, and also it's going to be a little bit more work. But there are traders that love to scalp, right? And when I say scalp, a lot of people think 1 point for the ES, 2 points for the NQ. I like to use the term scalp to run. Trying to trade consistently, and profitably, shooting for like a 1 point at a time, it's I'm not going to say it's impossible, but it's next to impossible. You're not going to be able to make money over the long term doing that. The reason why is because you can only have your stop so tight. It could be like a point or point and a half away, and if you're going for a point and a half, it's a 50-50 bet then. So scalp to run means you can get in, you can hit a point or two on the ES, let's say, and then you let it run for a little bit longer on some of the trades. And that's going to be a more profitable way to trade the system. And the training videos go through that. So with the power scalper, you will get lots of alerts per day. And you can be going for little singles, doubles, triples as far as your targets go. And they're meant to be quick trades and you can get some follow through. But remember, the only difference between a scalp and a runner is just how long you hold on to that trade. So you can take a scalp entry and then stay in that trade and trail it. You could stay in it half the session. So the momentum breakout system is a different type of approach where we're trying to focus on catching the major trend of the session, right? We're trying to stay away from all the little wiggles and go for the grand slam home runs. And the idea is to get a very well positioned entry shortly after the open and try to ride it out through the entire session. And we take some profits along the way. There's a couple targets so that we can at least pull some off the table. But our goal is to stay in the entire session. Now, as I mentioned, you can trade both of these. With the micros now, you can go in and pick one symbol for the what that you like to scalp and one to run the momentum breakout on. Some people really like scalping the ES, so then you could turn around and run the momentum breakout on the YM, let's say, or you could run the momentum breakout on the ES and scalp the NQ. A lot of folks love scalping the NQ. So you can mix and match, and there's no problem running both of these at the same time if you are a, aggressive trader that wants to, take advantage of the two forms of playing the market. All right, well, let's go ahead and go to that next slide. So this slide here shows you basically the kind of targeting that you can expect. And with the scalper, and those are the -S channels, like I said, you can go for like on the ES, you can go for like a point, couple points, or you can let things run out. And we've had a pretty robust market the last couple of weeks with a lot of point traction. So we're getting, these numbers even look small that I'm showing you on this chart. With the momentum breakout, we're looking for the bigger moves across the field, basically 20 points, 50 points. And like I said, recently we've seen much larger point gains over the sessions coming for us. All right, let's take that next slide, Bill. So let's start to focus on the momentum breakout system now, momentum target system. Sometimes I'll call this the EZ system. This system is designed to be easy to follow and easy on your nerves, and it's completely mechanical. The power scalper, that will, like I said, that will require a little bit of trade setups and discretionary, entries and that type of thing. The momentum breakout is completely mechanical. You just follow the numbers. You don't have to second guess the system or really think about it too much. The first concept that we want to get across here is that when the market trends, it usually trends like right off the open. And, we typically get on a good, strong trending day throughout the entire session, you'll see kind of a stair stepping motion. We'll move up to a certain level. We'll go ahead and level off a little bit, and then we make another run higher, and so on and so forth, until basically what you see is on the open is on the left side of the chart, and on a long day the close is way up on the upper right corner, right? And vice versa for a short day. So the momentum system, what I want to get you to think about is get away from the scalping concept and the wiggles concept. Our end goal is to run the ball all the way down the field. And so we're, like I said, we're trying to place an entry somewhere after the open, a key position, and then we want to try to stay in for as long as possible. All right, let's go to that next slide, Bill. Now, the momentum breakout target system, again, the desktop alert software, what's nice about it, you can have that sit on your desktop on one of your monitors, and you can be looking at your charts elsewhere. And the software is going to give you all the pertinent information that you need to be able to follow this mechanical system. You're going to know what the morning range is, so that gives you your visual reference point of the session, right? I mentioned this in the training videos. That initial range, the main reason it's in there is for a visual reference point for you. And we won't trade short above the range high in the morning, and we won't trade long, below it. So that lets you know right away visually what the market's up to. If we're up above the high of the morning range, then you will naturally be thinking the system's going to try to get us long, and vice versa. So the software gives you all the pertinent information. It gives you the trade barrier that we want to actually take the entry off of, and then the targets and your trailing stops. And you'll notice there's a system notes section, and so automated notes go through there, which serve two purposes. One, to archive what the system's done through the session. You can scroll back down there and see how things opened up and then how they've progressed. And the other is to just give you the real-time alerts. You can be sitting there, you'll hear audio type alerts, bings and bells and whistles, and audio voice, synthesized voice, and you'll be able to read what the latest information that's coming through the system. That's in the system notes. Also, we use that if we need to send out information to you folks, like the meeting today, for instance. Okay, so if you look over on the right there, the momentum target system basically will give us two targets. We get a trade barrier, and that's where we're going to try to take our entry around, right, past, and then we're going to get two targets, and the system's going to give us a stop. All right, let's go ahead and take that next. Okay, so this next slide here, what we want to go through is the different market day types. One thing to understand with the momentum breakout target system is its follow through is going to be directly dependent on the market day type. So we basically get three flavors of market day types. We'll get the long range days you see over on the left. Then we're going to get medium uh, range days, like medium trending days, and a lot of times these are reversal days. The market will attempt to go in one direction and then turn and go in the opposite direction. And then finally, we get the very narrow range, sluggish, low energy markets, the doji bars, where the market doesn't make much traction throughout the session, and we typically close somewhere around where we opened. Now, those three different types of days are going to give us different results with the momentum system. So work backwards now and just talk, the momentum system is completely mechanical, so that you can just basically follow the numbers. And so again, the results and the follow through are going to be dependent on the market day types, because the mechanics of the algo are directly tied to the momentum in the market. Okay. Let's take that next slide there, Bill. All right. So this is how it breaks down. You can just keep this in your head. Uh, there's 22 trading days in a month. And so 20% of the time, we're going to see strong trend days. And this is where we basically, the markets take off very strong from the open. They're going to hit all of our targets, and the market keeps on a trucking, right? Long range day. So 20% out of 22 trading days, you're going to see we see roughly 3 to 5 long range days in a trading month. Now, 50% are going to be our medium trend days, and those are where we can hit, either the first target, second target, and then maybe the market doesn't move too much further than that and reverts back towards the opening range. So we run into those 50% of the time. Now, those days are, some days we'll hit the first target and that's it. Some days we hit target 2, and those days can be profitable, but they're not the huge profit days. And then finally, we have our trend failure days, and those almost entirely correlate to the narrow range doji bar days. And that's about 30% of the time. So that's where we're going to get our stop outs and our mixed results following the system. All right, let's take that next slide there, Bill. All right, so I just randomly took snapshots of different daily price bars, and this is the S&P, and you can see they correlate to the 3 types I just was talking to you about. And so on the left, we got the big long range runners, and you can see that a lot of times what happens is the open is near the far end of the range and the close is on the opposite far end of the range, right? And so if you think backwards, and this is exactly how I designed the system, we want to catch those long range days. That's where the big point gains come from. And so the idea there is, if you look at these price bars and see how they're closing towards the end of the range, what that means is all we got to be able to do is ride out the session towards the close. If we can just plant a seed and keep that seed in the market until the close, that's how you catch a long range day. There's no other fancy footwork to it, right? You just stay into the close. Now, the tricky part is knowing where and when, how close and how far away to keep the trailing stop. And that's what the momentum system is good at. The middle section there is where we get the narrower range type of days, and we also get the reversals where the market will head in one direction and then it reverses midday, goes right back in the opposite direction. And on those days, we can hit targets. We've had days where we hit 2 targets to the upside, market turns on a dime, goes the opposite direction. We hit the 2 targets on the opposite side. So that is one possible follow through. And so even though they're narrow, they're more of a narrow range day and they're not like a full trend day, they can be profitable when we get these kinds of days where we hit all the targets. Now, the final group on the right there, the very narrow range types of bars, these are the problem child. These are the days that we either get no action, the market's so dull, and a lot of times it's around, it could be towards holidays, there are no entries, right? Other days, what can happen is there's just enough energy to hook us into an entry, but then the market fizzles right away and we basically drift down and we can hit our big wide stops, right? So the main thing when you're following the momentum system, and again, you want to follow it mechanically, is the the results of the system are directly dependent on the market date types. And so, yes, if we have a stretch of the very, very narrow range, low energy days, our results are going to, um, diminish. When the markets go gangbusters and we get lots of long range days and we catch the runners, that's where we can pull in the big point gains. So one of the issues is if you come in and try to trade the momentum system and you want to hit like a certain quota each day, you know, to be happy, that's not how this system is designed. You would want to focus on scalping that way, and then you could go for like fixed point targets for the day and whatnot. The momentum system strikes when the market's hot, and that's where it rakes in all the big point gains. So you got to be playing the market to catch those. All right, let's take a look at the next slide. All right, so let's talk about the mechanics of actually following the momentum system. Uh, it's very easy to follow. It's easy to get your head around it. It's easy to start following it. It's mechanical, and so you don't have to learn all kinds of fancy trading techniques and uh, be on the seat of your pants all day trying to uh, take razor thin entries. It's a very low key type of system to follow, easy on your nerves to follow. The entry is basically just a 1 minute close past the trade barrier. So if you're looking at your charts, you don't need anything more than the software and a 1 minute chart. You don't need any moving averages. You don't need any oscillators. You don't need to look at all kinds of different charts. It's that simple. A 1 minute chart, and you confirm your entry by a close past the barrier. All right, let's take the next one. Now, it even gets better because you can actually trade the momentum system, because I keep mentioning it's completely mechanical, and you don't even have to look at a chart because the software gives you all the pertinent information as the system is unfolding through each session, and you actually also get the entry confirmation. So you could actually just be sitting there with your trading DOM, your price ladder, not even looking at a chart. And when the entry confirmation comes through, you're going to hear a little audio alert, trade confirmation, and all you do is press the market button and you're in. It's that simple. And over on the right there on uh, the trading DOM, what you probably want to do to make it easier is just set yourself up a little ATM that has your positions set out so that it automatically puts your stop in and then puts out two targets, and then you can just drag uh, those orders to the correct levels according to the software. All right, let's go to the next slide. Okay, so diving into the mechanics of the algo some more. So basically what we're doing in each session is we're letting the market cool off in the morning. So you'll notice that the momentum system comes online 5 minutes after market open. Now, a lot of traders will say, oh yeah, I'll wait for the first 30 minutes and wait for the first hour, wait for 20 minutes. The problem with that is you can miss ginormous moves waiting around in that period of time, right? So I've been able to come up with ways to measure and figure out which way the market, which direction the market is likely to take after only 5 minutes of letting the market cool down a little bit. That 5 minutes gives the market a chance to set some boundaries and also uh, calm down a little bit. Now, the way it works then is the opening range. Again, I mentioned that it's mainly for you as a visual reference point. So that way, you can just visually know, like, hey, we're breaking above the opening range. Therefore, I'm going to be looking to get long, or vice versa with a short. The momentum algo will then hunt for a trigger price. And I like to call that like a trade price barrier. It's not where we want to take an entry, it's the barrier to taking an entry. So as long as we clang around below the trigger line in the example of a long, there's no entry. We have to actually get past that trigger line to be able to want to take our entry. And so the basic mechanics are that once we get that 1 minute close past the trade price barrier, the trigger line, then the alert software, you'll see that your targets will come out, will be sent through, your initial stop will come through. And the initial stop is typically wide, and you'll see it typically on the opposite side of the morning range. Our goal, remember, our main goal is to be in until the end of the session to be able to catch those big long range days. So in the beginning, we have to give the market enough wiggle room and stay out of harm's way, and so we don't get knocked out by any early morning volatility, price gyrations. That's why we have an initial wide stop. Now, as we once we're in an entry, as we get up close towards target one, we hit target one, you're going to see that the initial stop will shift and it will tighten. Now, what you're going to see is over the series, that ends up being around break even. Your stop loss is not going to be sitting at your entry. However, you've taken a profit and then you've cut your stop by about that amount. And so you roughly will be around the virtual break even level. Okay, now I say around because you're not going to see that every trade. This is a dynamic system that computes its levels off of the ATRs in the market and the volatility in the market, right? So you may see a day where target one is not that big of a target, and so when the stop comes up, it's not identical, to what we just gained. However, on other days, you're going to see the target could be further out, and there it'll be when the stop comes up, you're actually past break even. So it's going to be mix and match, but over the series, it's around break even. So the main takeaway here is our first goal is just get our positions to target one. That's getting the plane off the runway. If we hit target one, it's like castling in chess, right? You get to a point of, semi-safety on the position. So our first goal is target one. Now, according to our stats, we have target one gets hit 75% of the time or greater. In hot markets, we run, over 80% of the time we're hitting target one. And so the idea there, if you just think statistically, we've got a system that with high frequency can hit target one. And once we hit target one, we take the heat off. right? We reduce the risk for, the big stop out. All right, let's go ahead and get that next slide, Bill. Now, real important with the momentum system is, again, and I started the discussion off with this. Our goal is to be in for the long range days. That's where the big edge in this strategy comes from. Now, if you're a discretionary trader and a lot of the discretionary traders, scalp to run traders, use the momentum system to uh, trade above the breakout levels and go for the targets, but they're doing it in a discretionary manner and kind of scalping and scalp to run, and that's fine. It works great for that. But if you follow the system mechanically and you're just going to use the wide stops and follow the system stop, then the big edge comes from the long range days. So we need to keep that in mind. So the optimal position is that we have something to hold as a runner. So this gives you a breakdown of what you can expect over the series. 75% of the time we're going to hit target 1, 50% of the time we hit target 2, and then 25% of the time we get like an extended, move past target 2. And over the series, this is another way to think about the system. This is not a trade by trade system like if you were scalping. Don't think of it that way. You want to think of it session by session. So each day in the market at the end of the session equates to one move on the chessboard. All right. Even if we took multiple entries, if we had a trailing stop hit and then the system issued a second alert, the end of the session result is the result for the day. And that's how we want to think about it. So over the big series, we're going to see all kinds of variations on the follow through. We're going to see days where, we blast through all the targets and we run. We're going to see days where we hit only target 2. We're going to see days where we only hit target 1. We're going to see days where we hit target 1 and target 2, and then the trailing stop takes us out later at like maybe the midpoint between target 1 and target 2, you see. So our target 3 ends up being, a little less than target 2. So we get all these different flavors and variations on the follow through. But mechanically over the series, you're going to have a profit edge if you can hold a runner. So the ideal trade configuration, if we're going to start off with the micros, is 4 contracts. 2 come off at target 1, 1 comes off at target 2, and the final contract is held as a runner. Now, the most important thing, and you can trade different distributions of contracts and whatnot, but the important thing is you balance it so that you're taking off at least half at target 1, because that's what, remember, we got a high frequency rate to hit target 1, and once we get there, we're at or around a break-even level over the series. So if you keep it balanced so that you're taking at least half off at target 1, then you have an edge by reducing the risk every time we hit target 1. And then you can let the remainder run. Now, let's say that you can only trade 2 contracts. Well, get in the habit of, you can mix and match a little bit. So you hit target 1 with 1 contract, and then you can let contract 2 run for the day, right? Let's say that we have, you catch a ginormous runner, off the charts. Typically, markets cycle up and down in volatility and volume and range. So it's not impossible, but typically after a huge long range day, we tend to get a more muted day the following day, right? So let's say you catch a huge runner with your 2 contracts, one off at target 1, and the second one just ran through the whole session. And the next day, you could say, okay, you know what? I'm not going to push my luck. I'll go ahead and just take target 1 and target 2. If you notice, if you feel like we're in a sluggish market, target 1 and target 2. But occasionally you need to open it up and try to take runners. So again, the ideal configuration is when you can get to 4 contracts, 2 off at target 1, 1 off at target 2, and the final to run. And as you build size, you just keep uh, you know the equal distributions. Let's say you went to 8 contracts, so you take 4 off at target 1, 2 and 2, so on and so forth. All right, let's go to next slide. Okay, so we're going to take some examples. These are just from this week. We had a really good week this week following the system. We had a lot of momentum in the market. So the data is not important, but what I want to show you here is just the basics of how you're mechanically following the system. So notice there at the bottom, we got the trade price barrier, 37.75.50, where you see the down orange arrow there is right where the alert software issued that. And then later, we broke above that. We would have got our 1 minute close right there, and the software would confirm it. And right at that point, the algo will send out the 2 targets. So you can see up the top there, we got T1 and T2, and then nothing more than just let the market drift, follow the numbers. And you can see we just drifted right up. We hit target 1, target 2, and the market kept going. Later was taken out by a trailing stop. All right, let's take a look at the next one. This next one is a short example, and again from this week, and you can see that or this might have been the previous week, but you can see we had our trade price barrier, the blue line, and you can see there was some volatility around that line. But again, this is a strategy that's designed to be easy on your nerves. You take the entry, you set the stop, don't fret the wiggles. If you focus on micromanaging the wiggles, you can get yourself wiggled out. And so over the series, the wiggles are just like ripples in a stream. They pass and market will pick a direction. So here's an example where the momentum system gave the 2 targets, T1 and T2, and after that initial volatility around the point of entry, we ran down and hit target 1 and then ran down and hit target 2. Now, a couple of things. In any kind of a trade entry, whether you're scalping or you're taking a momentum entry, we always get 2 flavors of follow through. One is the trade that takes off like right away, like we get in and it just bolts in our favor and never looks back. Those are the ones we like. And the other is where we get a tug of war right at our entry point. Back and forth and back and forth, a big fight between the bulls and the bears, right? Buyers and sellers. And so here you can see on this entry, we did get that volatility around the entry point, but you're following it mechanically. You're not worried about wiggles. You take the entry, place a wide stop, you wait for the system to issue the trailing stop moves. The other thing that I want to point out is notice the targets. The momentum system, part of the secret sauce of the momentum system and part of the real accuracy is the precision of the targeting. And so you can see how in this example here, price ran down, hit the target, and that's exactly where price turned, right? Because that was like a key level in the market that the algo had computed out. Target 2, same thing. Look how we ran down there and hit that target. That's right where the market bounced off of. So you're going to find that as you watch the momentum system, you may be amazed at the accuracy of the targeting. We tend to run right into those targets and hit those on a dime. Okay, let's take the next slide. Now, again, just to reiterate, the big advantage to following the system and the big edge that you will achieve is holding runners. Here is the follow through on the slide we just looked at where we hit T1 and T2. And so if you're one of these traders that say, oh, I'm just going to take target one, I'm just going to take target two, and I'll be happy. No, look at what you give up. All right. So the market does and can, melt down or melt up. We get super mega rallies to the upside, and they can come out of nowhere. And a lot of times they're based on news, right? And if you're holding the runner, you catch these point gains. And this is where our edge really can come in. And so get in the habit of the main thing that you want to work towards is you want to work towards that basic four contract configuration. All right, let's go ahead and take the next slide there. Now this graph here shows you a real key concept with the momentum system. And I want you to picture this in your mind's eye and keep this in mind while you're following the system. Our big prize are their long range days. Target 1 and target 2, yes, you are locking in some profits, but you don't want to think of those as your main profit vehicles. Target 1 and target 2 take advantage of locking in some of the gains while we have them. A bird in the hand is worth two in the bush type of concept. And they mainly help to offset the stop outs. All right. So again, let me repeat that. Target 1 and target 2, although they're fun to hit, their main job is to offset the stop outs, right? And it doesn't mean that, we can go through like really great market periods and target 1, target 2 are making you tons of points, right? It doesn't mean that. But over the series, you're going to find that even with the big stop outs or half stop outs, that type of thing, your T1 and T2 help balance out the stop outs, right? And so that's over on the left of this graph, right? Your small drawdowns and your small T1s and T2s, they balance each other out. Then when you hit the long range days and you have the runner and you hold into the close, that's your pure profit that the system generates. Okay. So again, that's why I'm trying to reiterate that the real profit edge comes from holding the runners. And the great thing is it's no big amount of extra work. You just keep your hands off the keyboard, sit on your hands. You let the trades work. You follow the system, right? Okay, let's do the next slide. So here's a perfect example of where holding into the close and holding runners can make a big difference. This is the big market meltdown, and I'm trying to remember the dates now. You remember the dates on this, Bill, where we had the 1,000-point drops? We have a blog post about it.
Yeah, it was
Uh,
last spring, like end of
yeah,
February, beginning of March.
yeah, and I'm trying to remember what the catalyst was, but it
The
was
pandemic.
no, this was last year. This was before that.
Oh.
I think. Well, anyways, this is where we had literally 4 days in a row where the Dow dropped 1,000 points. And, again, if you're fixing your targets at, 1 and 2 points and that makes you happy, you're shooting yourself in the foot because look at what you can give up. And the momentum system is designed, again, to keep you in for the long range moves. So when we get major market meltdowns, the normal swing traders and stock investors and whatnot can really feel the pain But as e-mini traders, where we can short the market, the momentum system can really clean up during these periods. So in your mind, just keep your goal is to have runners in the market to be able to take advantage of these types of situations. Okay, let's go and we're going to talk about another concept here, the drawdown concept. Let's go ahead and go to that next slide there, Bill. Okay, drawdown. We're going to talk about drawdown. Drawdown affects all trading systems, period. It doesn't matter how good or how, what percentage of win rate or how fancy the setup is. Drawdown periods will occur. And I'm talking about drawdowns in the account. So this is where you just have like 3 bad days in a row. And so there can be reasons that drawdown uh, hit, and it's usually directly related to market conditions. We can either have super dull markets where we get hooked into stuff, but the markets just never follow through, right? And so there's just not enough energy to hit any targets. We're getting hooked into false moves, and then the market, can drift down and hit our stops. Super dull, low energy markets. The other can be super high energy but high volatility markets where the price swings are so great back and forth. It's like, throwing a frog in a blender, and you get into an entry and you can just get chopped up, right? Those days occur as well. So whether you're a scalper or whether you follow any other kind of strategy or whether you're following the momentum system, there are going to be market conditions that just don't line up with the mechanics of the strategy, right? There's a big misalignment on that day, and um, stops get hit, and we can have losing streaks. So you can have multiple days in a row that lose and create the drawdown effect. So the first thing that you got to get through your head is all systems have drawdowns. Let's take a look at that next slide. Now, when we look at our trading account and we look at an equity curve, let's say that we have a system that's profitable, and we start off with some starting capital, and then the system is running, and our strategy, our system is making us points, and the account's starting to grow in our favor, right? So this gives us a smooth equity curve to the upside, and we're basically padding our account, the original capital, with house money, right? The system made us the money. Now we got a buffer of money, and everything's great. Let's go to that next slide. So let's say then that we get a drawdown period. Could be a couple days, it could be a lousy week, and we give some back. So when the markets are hot and the momentum is strong and the price movement is smooth, we can incur nice gains, day after day after day after day. Then we can hit a rough patch, and the market causes us to give some of that back. So that is a temporary drawdown period. Those occur, right? Doesn't matter what trading, this is a general concept here. It doesn't matter what kind of trading system or strategy you're following. Now, here's the difference. If the drawdown period occurs after you've already made some house money, right? The system has made you a bunch of money and you've got a nice big profit buffer sitting above your starting capital, then it's no big deal, right? You just push through the series. And that's the way the momentum system is designed. As long as you continue to pull the trigger and push through the series, the strategy is self correcting and it will, rebuild itself after small periods of drawdown. Okay, let's take a look at the next slide. The issue with any trading strategy, right, and with the momentum system can be that you get your drawdown right at the beginning, right? Right when you decide that you're going to start following this great system live, right? Your dumb luck is when the market, gives us a rough patch and we hit some drawdown. And what happens? It eats into your starting capital. So what happens then is you get that emotional response that you get in trading, which is you see your hard-earned money starting to disappear, right? That causes you to get gun shy. And a lot of people, this is where they drop out, or they just stop, they'll stop pulling the trigger, right? They're afraid to continue. So the key here is this: the system works over the series and it works mechanically, but you have to pull the trigger. You have to work through the series. And I just showed you, like, if you're already into a nice profit buffer in your account and we hit some drawdown, it's no big deal. You just keep pressing the button, keep following this system every day, and it self-corrects. If it happens at the very beginning, then this can cause you to abandon the system. And this uh, scenario right here is what is responsible for most people abandoning and stopping to follow the momentum system. They come in gung ho, you look at it a couple days, dive in, and then maybe we got a rough patch the first couple days of live trade. They hit some wide stops, they quit. Never had a chance to let the system even get off the runway. So I'm mentioning this because, and this is true of any trading strategy, and this is why a lot of traders, they jump from system to system to system to system, have a ton of trading books, never made any money. They can't stick to one thing. They get hit with the initial drawdown. So let's talk about how to deal with that. The first thing is realize this is a possibility. Now, you could have great luck. You start following the system live, and the first week or 2 weeks is gangbusters. You're making tons of points. Everything's great. If you get a little drawdown, you're like, I don't care. I love this system. I've seen how it works. I'm just eating into a little bit of house money, and I'm going to keep, pulling trigger. On the other hand, if you start off and your first couple of days look like this, you can easily get gun shy. So important thing is, one, start off very small. When you first start with the momentum breakout system, I recommend that maybe you adopt a 1 month immersion plan. The first week, I recommend everybody just kick the tires and learn how to take the trades on sim mode, where you're getting your ATM set up and you're getting the mechanics worked out of how you're going to trade the system on your charts with a chart trader and drag things around. You're going to trade off the trading DOM, work through that on your particular platform, how to get the orders placed properly, and spend a week and do that. Right, you're not going to miss anything. The system's going to be here the following week. And so do yourself a favor and do your own due diligence and work through those basic mechanics. Then the second week, just to break the ice, dip your toes in the water a little bit, just drop a single micro contract in and just go for target one. Just make it easy and get some easy, quick wins to remove some of the fear, right? Desensitize yourself. Week 3, going with 2 contracts. And then you're going to go for target 1 and target 2. Keep it real simple. Just everything's mechanical. Now, at the end of week 3, if you're profitable, right, then your final week, just go straight to 4 micros, 2 off at target 1, 2 off, 1 off at target 2, and then 1 off as a runner. Okay, that is one way that you can gracefully immerse yourself, following the system. And it's not like, a bull in a china shop where you're diving in with huge positions. The other highly recommended thing you do is, before you start to follow this system live, send in risk capital for this system, right? So let's say that you got like a couple grand sitting in your trading account. Go ahead and send in a couple $100 or $500. That's your risk capital to follow the system. That way, you can say, okay, look, I'm going to invest this, $300 as risk capital. I'm not going to worry about it if I lose it, right? But I'm going to protect my original capital. I can't go down into my original capital. I'm going to send in this risk capital on top of that. Then I can start following the momentum system, and I can do it with total peace of mind because I know I'm not going to lose any of my original capital, right? I'm only going to run the system off of the risk capital that I send in. And that gives you a real peace of mind, allows you to just continue to pull the trigger, because your worst scenario, all right, I can't tell you how many times I've seen this. People start off, they hit a rough patch the first couple days, they quit, only to have the next week be one of our best weeks ever, where not only did it make up all the stop outs, but it made lots of net profits that following week. And all you had to do was keep pulling the trigger. So, and I've got a great video. We have a great video in the knowledge base about trading off of risk capital. It's way down at the bottom. It's something like how to not to destroy your account, trading off of risk capital. Highly recommend you watch that, because that really goes over the concept that I just talked about. Okay, let's do the next slide. All right, so to wrap this up, let's talk about one final thing here. Now, I'm going to give you uh, a little enhancement to following the momentum system if you want to be a little bit more of an aggressive discretionary trader. There's two types of people that follow the momentum system. One can be like the busy professional, not interested in being like a pro trader and learning all the setups, and not interested in all the action. They're busy, they're trying to do other things. The momentum system is great because it's just mechanical. You just follow the numbers. You're like flying in the clouds and on instrument panel, right? um, that person may not even care much about the markets. They just want to make money. The other type of trader is one that is real intense, focuses on the charts, watches the action. You try to stay in tune with the markets. It's your thing, right? And so if you're one of those, here is a little enhancement if you want to uh, reduce the risk a little bit, but also increase the profit edge over time. And I'll give you the pros and cons. Now, this is also something you can do when you're first starting off, right? When you first start off, you can adopt this, and it'll keep your risk to a minimum. So the issue is this. We know that our main extreme goal is to stay in till the end of the session. And many times, some of the biggest days, right, that close on the opposite end of the range, right, ginormous point gains, had some very volatile opens, right? They wiggled all over the place before they finally took off. And so the momentum system gives a wide berth on the initial stop, right? Our goal is, we're just trying to not get knocked out. We're betting on a direction for the day, and we're trying to just stay out of the way and not get knocked out of that. Okay. Statistically, we're going to hit days that wiggle all over the place and then take off, and we get a long range day. And at the end of the day, like if you had just taken the entry and went back to bed and then woke up at the close, you wouldn't even have seen all the scary action in the market, but you just would have like woke up to the big profit, right? And that's just going to happen by itself statistically. We're going to get those kinds of follow through. However, we're going to get days that hook us in and can run down and hit the big old wide stop. And sometimes because this is a dynamic system, we have some big ranges, like really big ranges at the open, and so our stop can be really far away. Now, just real quick, we've recently made some enhancements that have to do with helping out with the volatility. So we won't see like these ginormous stops and stuff like we've seen in a couple of days recently. We've had some off the charts volatility at the open, and that just skews everything. So I made some enhancements that cut down on the volatility. But that being said, what if you want to trade this system and not allow the full stop out, right? We can do that. And here's the way to do it. Now, the two horizontal blue lines there represent the morning range, okay? Morning high, morning low, and that's you got those levels right in your software. If you're a Ninja user and you're using the additional on chart indicator, then you have those automatically plotted, those lines. And then we get the trade barrier that'll occur outside the morning range. Now, what can be done is we can protect just below, we're going to use a long example here, just below the high of the morning range. Okay, so think about it. Our normal stop would be, we'd have our entry above the trade barrier, the green line, and our initial wide stop would be all the way on the other side of the wide the morning range, right? Now, again, over the series, it still quants out totally net profitable, but it can be scary in the beginning. And plus, there's some days that just have big, big ranges. So we can then protect the bottom of that morning range. And so what we're doing is we can literally cut the full stop by 2/3, maybe more even on some days, right? But here's the catch. We can't just drag a stop up and put it underneath the high of the morning range, right? That doesn't quant out statistically. That leads to too many false stop outs that then go on to work. What does quant out, and this does statistically work, is this. We're not looking for a move just below the 5-minute range. We're not looking for a close below it. We're looking for the high of a 1-minute bar to separate completely. In other words, we want it to pull away and gap down below that morning range high. Okay. Now, the problem with that is it's a real-time trigger. That's why I said you got to be an aggressive trader that wants to sit and have this plan in mind when you take these entries. We can get price wiggle around and bang around and bounce around that morning high up and down 15 times, right? And then the market can take off in our favor. So that's why you can't just stick a stop tight below there, because you'll just get knocked out. It's statistically is a losing way to do it. However, the first 1-minute bar that's able to pull itself away, right, break free and not touch the top of the morning range high, that's the bar you just exit on the close of that bar, right? Just hit the flatten key and boom, you're out. And the majority of the time, you're going to be able to cut your full stop 2/3 by 2/3. Now, couple things to keep in mind. We could get a price shock where that 1 minute bar does run all the way down. The high is not touching the high of the bar is not touching the morning range high, but by the time it closes, it already runs down and hits the wide stop. That's possible. We get wacky, strange price shocks in the market sometimes due to news and tweets and things like that, right? So that's a possibility. The other is you could see a bar. And what I recommend you do when you set up a 1 minute chart, just most of your platforms have little bar timers. Put a little bar timer, you can see the countdown. So you could see a bar that's looking just like this, right? It's going to, the high is down below the morning range and you're counting down. You got like 5 seconds left. You're ready to hit the flatten key. And at the last second, boom, price pops up and you're back up touching the range. You stay in. Okay. So you can last second reprieve, right? That happens. So this is a little aggressive technique you can follow. Now the pro is that, yeah, you don't get the big wide stop hit. And if we've got a day that's got extra large ranges, opening ranges and whatnot, then you can prevent a pretty big stop out. On the other hand, you could see price come all the way down, and we see this a lot. Price can come all the way down one lousy tick from the full stop, turn around, go on to be a big winner that day, right? And here you micromanaged and you knocked yourself out with a loss. So here's the rule you follow. If you're going to follow this quick stop out methodology, be prepared for a potential second entry. And it's just as simple as if you get stopped out and later you get another 1 minute close past the barrier, you're in again, right? And you're just going to protect the same level. In a way, it's 6 to 1, half dozen to the other, because if you think about, if you take 2 stops with this methodology, it's probably going to equal 1 full size wide stop out, right? So using this, don't be afraid to use this aggressive technique is what I'm trying to say, because you can get stopped out. 20 minutes later, you get another entry confirmation. You get back in. A lot of those second tries will take off. All right. So this is a methodology you can use. And in the beginning, you might want to adopt this so that you're not like hitting full stops. And one final thing in relation to this, and then we'll get to some questions, is as you build size in the market and you follow the system mechanically, and what we're doing is we're trying to quant out our gains over the series over time, right? If this momentum system works out for you and you stick around, you'll be trading this week after week, year after year, right? This is a robust system. It doesn't change. It keys off of the inherent dynamics of the way the markets work every day and will always probably work, right? As long as the building is still there. So one thing you can do as you build size is you can begin to hedge, which is what all of the big quant systems, do. And what I mean by that is, let's say you went in with 8 contracts, you protect half of the position at the aggressive stop and you leave the other half with the wide stop, right? So you basically mix the two. So because then you're going to have follow through that'll be advantageous to do it that way, right? Anyway, that is the aggressive protection method. We're going to have more documentation on that. And what I really want to do is I'm going to make a video that shows some trades in action and how it would actually look following it in action. Okay, Bill, let's go to that final slide. And then we can go ahead and start taking questions if there's any final questions.
All right. Yeah,
And
that's
if you can think of anything I missed or didn't cover, let me know and we'll talk about it.
You know, that was really interesting. I like the aggressive, the little strategy there. So I was waiting for you to get to the part where you were going to mention that it is about re-entering the trade. You take a smaller stop, but literally, a few minutes later, when you get that next close, 1 minute close past the barrier, then you would re-enter the trade, and so it may work, right? But if it goes all the way to the opposite side, well, then you've taken a much smaller stop out. So
Right,
yeah,
right.
very, very
And
cool.
and think about it this way: the smaller stop out um, keeps you in the game, and just you get more plays. Right now, one thing I didn't mention is with the momentum system, our main goal is to plant a seed and ride the main direction of the market. And on a lot of long range days, that's great. It's like hopping on an escalator and we just ride along, right? The market picks a direction and it doesn't deviate from that direction the entire session. Other days swing around wildly, and we can actually run in one direction, hit target one, and then the market can swing and go the opposite direction. We get an entry in the opposite direction. So that being said, what I recommend is when you're following the system mechanically, get in the habit of always taking at least 2 attempts per day. Okay. In other words, if we catch the one big runner, then that's it. You don't need any more trades that day. But if we get knocked out, whether you hit a target and get knocked out, or you hit a stop and get knocked out, you pull the trigger on that second entry, because the second entry many times can be the one that takes off. We get markets that have volatile opens and they want to go test extremes before they pick a direction, right? They knock stops out, this and that, or here's a real good example that we see. Let's say the market's been going down for all week, 5 days in a row, and then we get a big ginormous climatic, you know long range down day, right? And then the following day, it's even more extreme. The market's gap down even, right? Uh, Now we have a super oversold market. They've they they totally sold off. All the big sellers on the long range day down. Then we even gap down, and we run all the way down to maybe a key support level. That's where we can see the market, make that first initial move in the morning in that direction down, right, to the downside, hit the support, turn around, and then we get the mother of all, bounces, right? And we go in the opposite direction. So that's literally where you can maybe hit target one on the way down, and then it reverses, or maybe we don't even hit target one, we get stopped out. But then the second entry is the one that is the big move. So just be aware that this is all about uh, statistical follow through, mechanical follow through. We're going to get all kinds of day types, and it just quants out over the big series in the long run. So make sure that if we get the second signal, you take the second attempt.
Okay, I have a question here about what time the momentum system shuts off for the day.
Well, okay, so the momentum system, the way to think about it is this: if we have gone and hit targets one and target two, and then later the trailing stop gets hit, then it's done for the day, right? This is not a trade by trade system. This is a session by session system. So basically, the algo is saying, look, we hit target one, we hit target two, the market fizzled. That's it. We're not going to risk anymore for the day. So let's say that we got a market that very early on ran and hit target one and target two, and then later, in the first 2 hours, hit the trailing stop, maybe further along. You're done for the day. That's it. You don't want to risk trying to go in again and give it all back. On the other hand, the market, we could, like I said, we could gyrate around and have stops hit, and then get a new alert like mid-session, and then we could run all the way to the end of the session. But so the end time is going to vary on basically the follow through, but definitely the system cuts off, and we're not going to see any new entries, like an hour and a half before market close, maybe even 2 hours now. The idea is catch the entry early and stay in the session as long as possible.
Yeah, one thing that since we're doing this doing a little strategy session here, I thought one thing that's worth mentioning here, which I think is one of the more interesting sort of dynamics of the entries, is how the 1 minute close past the barrier can vary substantially, and so that makes target one vary substantially, right? So there's certain times where the 1 minute close past the alert price trade barrier will be like a tick or two, which obviously is optimum. There's times where it can be a couple of points, right? And so what you may find is that taking the mechanical entry there, if it's a couple of points, so instead of target one being, say, 4 or 5 points, it only ends up being a point and a half. And that's just sort of due to the nature of the market. A lot of it is really dependent on the market behavior.
Yeah, that's a good thing to bring up and review. So what Bill just said is that when we get the system generated trade price barrier, and we're looking for that 1 minute close, we can have a day where the 1 minute close is like right past the barrier. We get a nice clean entry, like a couple of ticks past, and everything's great. And then we can get these super high energy markets that are extremely volatile, and we can see that before that 1 minute bar is closing, you're sitting there watching the countdown timer, and that dang bar won't stop. It just keeps moving, 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 moving. So here's the conundrum, or the issue. The system's job is to give us that breakout level and then generate the targets based on the market profile. That's the market profile you know, in progress. The price, however, is like the little race car that's driving around that market profile, and um, there can be days where it just, before we get that close, it can really take off. Now, here's the thing: the entry can be anywhere past the uh, trade barrier, right? It doesn't have to be a 1 minute close. The reason we pick a 1 minute close is we had to pick something that will equate to letting the algo confirm that yes, we're in, right? And also something just very generic that anybody could follow easily, right? Well, now it's not some strange bar setup, some strange configuration. It's just a basic 1 minute close. Everybody's got a 1 minute bar. It's a short enough time frame. So the majority of the time, it's not an issue. But we may see an instance where, like Bill said, we get a big long range 1 minute bar. It can be all the way up towards target one,
Or past
right? So,
target one.
or past target one. So here's how you handle that. If we're, let's say you get up and we're just close to target one, right? You long range bar on the 1 minute, you take the entry. Target one's only a point and a half away for the ES, let's say, right? Well, guess what? Just take the target. That's those are the levels in the market that day. We couldn't control how the participants, ran it through the gauntlet, but that's what it is. It is what it is. So just take the target one and just continue following the system as normal. Now, let's say that you get a day where that uh, 1 minute bar closes all the way at the target or past the target. What do you do? Well, you have two options. One is that, and this is the one I probably recommend, is just go ahead and take the entry, but just with half the position, just to pretend like target one already came off with your contracts. So then just enter on the remainder of the position. Okay. Now, and that ends up quanting out and working. And then you can, maybe use the aggressive stop out method I just showed you. However, as I mentioned earlier, we did make some enhancements to the system now where we're going to see a little bit less of the volatility like this. We've put some uh, uh, stopgap measures in there to control the volatility. So we may not see this issue occur as much. All right, so that's the way you deal with it. I'll have to come up with some good examples. Uh, I I would say that we see this maybe 1 out of every 10 times.
Yeah, it's kind
We
of an anomaly. Hey,
It's
one
an
quick thing I
anomaly.
wanted to talk about as far as like your little aggressive protection strategy that you went over is not the same as the aggressive protection level that the software actually displays in the system notes. Even though it's phrased similar, it's a little bit
Yeah,
different.
yeah. And here's the thing. I'm glad you brought that up because I forgot to mention one thing. What I'm going to do is an enhancement. We've got a couple little updates coming on the back end. And one thing I'm going to program in there is I will put in an alert for that. Now, the issue is that again, I said it's not where the system can just say, okay, put an aggressive stop here because we don't know where that aggressive stop is. It's based on that first bar that the high would, the range would close back inside the morning range, right? The range of the bar. So that's just kind of a dynamic thing that can occur, right? The system can't guess or project where that's going to occur. So, but I am going to put like some kind of a proximity alert saying, hey, price is touching the top of the range, be on alert for the aggressive,
Hey, let me ask you a
something like
question
that.
about that.
Yeah.
It seems to me, and I'm just kind of visualizing this, it seems to me that if you're going to actually use that strategy, you do want to use a little discretion. Like, just in theory, if the range was really, really narrow, right? Like you had a really small range, say it was like, 4 or 5, 5 or 6 points or something, and like you're getting price bars that are basically like poking at both sides of the range and that type of thing, or just the certain price behavior where you're going to see a move back into the range, but the range is really super tight. Would you still want to employ that?
Well, if you're going to follow that methodology, then yeah, because it's again over the series, everything just quants out with different, ratios and things. So,
Okay.
uh, yeah, I would. Here's the issue. In the end, the way you got to think about it, every time we make a change in a trading strategy, it's like a Rubik's cube. We can appear to be fixing something at the moment, but we end up over the long term screwing ourselves down the road in other trades, right? So we have to be very careful. The momentum system, the way it's designed, is quanted out as about as good as it gets, right? You can make this little discretionary uh, aggressive stop out and use that if you're a discretionary trader. If you want to sit there and do that, that's fine. Um, Again, that takes the heat off of like hitting a full stop, right? And but you have to be prepared to take a second entry. And get this, it is possible to um, you know get two stop outs, right? And the price to come down towards the wide stop and then turn around and be the winner. And then you've already taken two stop outs and you say, okay, I quit, throw in the towel, and then
Yeah.
you miss it, right? So no matter what, the market's going to stab you in the back at some point in some time over the series. It just happens. And the other thing that happens a lot is, the market can just take off and you can have winners just by being in, right? Just by for no reason at all. Just if you're in the market. I mean, in long time ago, I had my cat step on my keyboard and get me into a trade to turn into a winner, right? I mean, who the hell knew, right? It's just so things just quant out over the series. And so the point I would say is don't, if you're going to follow the momentum system, don't try to change it around too much. But if you're one of these like aggressive experienced high energy discretionary traders, that's doing scalping and this and that, by all means utilize the levels and the uh, you know the main breakout level and the targets. You can utilize that with the momentum system as well, as a lot of traders do.
Yeah, one of the points that I'd like to make when I talk to people about the way that the momentum system sort of a range breakout system is, the real beauty of that is that anytime that the market is going to make a significant move, right, it's guaranteed to have you in that trade. Like, in the morning, we don't know if the market's going to have one of those big long range days sort of out of the blue, but I've seen so many systems out there that try to trade like counter trend moves, right? Like the market is kind of trending in one direction, and then it looks like it's going to stall out and pull back a little bit, and they try and you know trade counter trend, and that's fine and dandy, but you don't know how far that counter trend move is going to carry. But the great thing about the momentum breakout system is it's trading with the primary trend of the day, and so when we do get those ginormous long range days, it's guaranteed that, just by the nature of the price breaking out of the range, you're guaranteed to be in for those, as
Yeah,
opposed to trying to trade the wiggles up and down.
right, exactly. And again, that's the main takeaway from following this system, is that the long range days is where the big point gains come from. So if you're not holding something for that, you're just shooting yourself in the foot. The thing about the markets are that many times, I think I mentioned 70% of the time, I think the markets move on technicals. 30% of the time, they are news driven. And so we can get days that are technically dull, but turn into big movers based on a news event, right? It just comes out of nowhere. And if you were trying to get in there and scalp all the little wiggles, you finally throw in the towel, give up. Whereas the momentum system might get you in, and things are just kind of drifting along low energy, but the trailing stop is still keeping you in. And then the markets blast off based on the news, and you're in, right? You didn't predict it. Nobody could predict it. Just some random news hit the airwaves. Then we get the perfect storm, where not only do we have like the most excellent technical setup, but right at the same time we get a news event that is a, exacerbates the move in that direction, right? Positive or negative. And so again, if you can be in those days, that's where so when you pencil out the stats like in a spreadsheet, week after week, month after month, you'll see how these big long range days really skew the odds in your favor and give you those extra points. And that's where the big trading edge comes from, the long range days. So good point.
Excellent, excellent. Well, hey, let's go ahead and wrap this up because here in the new year, we're going to be doing these training sessions on a more consistent basis, right? And so we can always get into some other stuff next week or the week after that. And so, hey, this
Yeah,
this is really good.
we'll shoot for a training on the power scalper maybe next Friday, and cover that, and just show you the differences, and both excellent strategies to follow, but just different animals.
All right, well, it sounds good. Hey, thanks for bringing all these good slides and this interesting presentation, and we will see you next time.
All right, see ya.